All right, we got a rare technical signal today on the market forecast indicator. So I'm going to break down what that is, how rare it is, how significant it is, especially in the short term. I'm going to break down the bear marketishness of this move that we've gotten pretty much since the beginning of the year, and how it compares to another very famous bear market that we've had here in the last few decades. So I'm going to break that down to see why has it been so bearish this year. And while a lot of people think that this move compares to 2008 in terms of being the end of a bear market, why that there is a really good established precedent that that's not the case. So I'm going to break that down. We're going to break down what's moving. I mean, there's some big movers. The dollar has just gone haywire. We're going to look at that, talk about its significance and what we think it means. And then we'll take a look at our trade idea of the day in a defense sector. And talk about kind of a unique pattern it has and how to trade that pattern. So let's go ahead and get started. Today is Monday, September the 26th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen. Hit the thumbs up icon down there to like our video. Comment on anything that stood out to you. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, as you're watching us here on our blog, check out some of these things over here on the right, including upcoming classes. Come down to the bottom, click that heart icon. It opens up this tab. Hit that like button there. Also click the thumbs up icon. It opens up another tab. Hit that like button. Again, the more you do that, it really helps us. It helps us get our content out to all of our followers on those social media platforms. That's why we always ask for it. All right, well, let's take a look at the S&P 500 with the market forecast indicator, as we always do. And you can see we've had our fourth consecutive oversold cluster today. Two now with these red dots down here. That is the first time that we've seen a 4-day cluster like this since 2018. It's actually only you can see it, well, we got 3 there in COVID, but in 2018 is actually over here. 6 times in a row. This 4-day streak is actually only the 6th time in the last 40 years that we've had it. Twice in 1982, here in 2000, today, 2018, 2012, incidentally, and then another time, I believe, in the 90s. But that's not, I highlighted it in a tweet that I put out earlier today. That's not very often. If you look at this period too, 12, 24, 18, let's go back, 12, 24, 18, back over here, and then we'll go 12, 25 of 17. So we can look at the 1-year chart there. That was the 6th day, was the first day that we had a red dot right down here on the PPO rank. So you can see, like, if you look at now, we've had 2 dots here on the PPO rank. This is the first time, we are close to the lowest level. Remember, the lowest level we got below the 30-day moving average was 9% over here on May the 11th. Incidentally, not over here, though we did get a cluster and a red dot. So again, getting a cluster and a red dot tends to set a low point. That tends to set, you're pretty bearish at that point, and that's about where we're at right now, being down nearly 9% and a 4th consecutive cluster. The intermediate line is now below the 5th percentile. This is unbelievably rare for the intermediate line just to get below the 10th percentile, much less stay there this long. Again, the last time we stayed there this long, below 10, was June of 08 when we started to move to and through the 200-week moving average that started the bear market of 08 and 09. And I believe that's kind of move. I believe we're in that move right now, the move that will start the bear market here. Again, if you think this is a bear market, if you follow me on Twitter, I've been posting out quite a bit about this. I think you'll find this interesting. If you think this is a bear market, let me show you something. I'll bring this over here. Okay, so let's just get this here. So we've had 6 months in 2018 or 2022, 6 months through September of 3% or more declines, including September, right? Including this month, 3% or more declines. We had 6 in 2008. We had 6 in 1974. We had 5 in 2002. But you can just see how rare. I mean, these are all the real bear markets that we had. 2002, 2008, 1974 were the last real bear markets. You can see we had 4 here in 1982, and we had a couple. We had a couple years of 4 in 2000 and 2001. We had a 4-monther there in 2010, incidentally enough. And that wasn't, obviously the same bear market there, and another small bear market here in 1980, 81, 82. So, but needless to say, interestingly enough, if you come down here, this, right here, out of all of these, we have all 6 months so far in 2008, we have actually been above the 200-week moving average for all 6 of these months. For comparison, in 2008, out of those 6, 4 of them came. 4 of those came below the 200-week moving average. In 1974, all 6 were below. In 2002, all 5 were below the 200-week. All 6 so far have been above. Let me show you this. In 2000 from January 2000, which is the first 3% decline, to March of 2001, which is the 6th one, we had 6 months of 3% or more declines, 6 months, and during that time frame, a little bit more than a year, and all 6 of those months were above the 200-week moving average, all 6 of them. Now you look at it, after that, once the bear market started, right in between there is when the bear market started. That was when we had the move to and through the 200-week moving average, right there, right in this period. After the bear market started, we had 1, 2, 3, 4, 5, 6, 7 months. By the time we got to March of 03, 7 months of 3% or more declines in the S&P 500. So just because we've had 6 so far this year does not mean the bear market started. If you think this is a bear market, then you would be one of those people that thought that that was a bear market. When in reality, the bear market was right here, right? That was just a precursor. The only reason why we had 6 of them before the bear market started because we were so bullish in the 90s. The reason why we've had 6 of them this year is because we were so bullish going into January. The only time we've ever been more bullish going into this January was in 1999, those late 90 years. Like, we were extremely bullish going into this year, and the fact that we've had 6, which is so rare to get 6, the fact that we have 6 months of 3% or more declines, and all 6 have been above the 200-week moving average, is, again, very similar. Now, again, this is in 9 months. Here, it took, 14 months? 14 months to get that one. It's taken 9 months. And again, once the bear market started, we had 7 out of another year. From August to December, about another 14 months, or excuse me, about 16 months there. We had 7 more in 16 months. So that kind of goes to show, if you think we're in a bear market right now, we've seen this before. We've seen this before, and that did not end the bear market. That didn't even, that was a pretty deep correction. Then you had to move to and through the 200-week moving average that started it. Then the bear market started. Then things hit the fan. And that wasn't even that bad of a bear market. It was just a long one. Right, we didn't have a great financial crisis or anything there like we did here. It didn't drop nearly as bad as COVID did. So it was just a long extent. This is the kind of bear market I feel like we're headed towards right now, where we get, again, we've already had 6, and Bespoke talked about how crazy that is. But the reality is, if you think that's pain, then you've got another thing coming. Right, we've got another thing coming. The only reason why you think that this is pain, the one that we're getting now in 2022, is because you were too bullish when the market was itself way too bullish. From March of last year, 21, up until this January, the market was already extremely overbought in March of 21 last year. They were already extremely overbought then. Then it rallied another 20%. So if you were too bullish then, that's why you're thinking this is a bear market. Because we should have never been that bullish then. The Fed should have been raising rates. They should have been already tightening up the reins already. The unemployment market was already really hot. The inflation was already really hot. I mean, everything was already there by March of 21 last year, and I talked about that in the videos last week. The fact that they didn't raise rates is why we rallied another 20% up to this January from that March peak, and why you think this is a bear market now. Because just like it wasn't then in 2000, the reason why it looked like one is because we were so bullish in the 90s. Just like it wasn't then, it's not going to be now. If can you imagine if people think this is a bear market? Can you imagine if we got 7 more months in the next year plus of 3% or more declines? For people who think we've already been in a bear market, what are they going to think that is if this is a bear market, right? So it kind of gives you an idea of just how bearish we are. And again, we're even that bearish in the short term. This is very, very bearish in the short term. We've only had one time in 60 years or 40 years that we've had 5 oversold clusters in a row, once ever, and that was the fourth quarter 2018, right after an FOMC meeting where they raised rates and they were kind of erroneous there. The real Fed funds rate was positive in December of 18. The real Fed fund, they can't, and a lot of people are thinking that the Fed's making the same mistake now, that they are too hawkish now, just like they were in 18. And they walked that back in January of 19. The market rallied all of 2019. They're not going to walk it back this time because in December of 18, the real Fed funds rate was positive. The real Fed funds rate now is still historically negative. More negative now, even though it's off of its lows. It's still more negative now than it was in the 70s when we had 2 instances of being negative 5% on a real Fed funds rate. We're at like negative 5.9 right now, or 6.9, or in that area, off of the lows. So that kind of gives, they're not going to pivot now and say that they were wrong. They're going to remain hawkish because inflation is persistently high, especially in the middle. When you take out the bigger movers, it's still way, way, way too high. Let's take a look at some of these other charts. Of course, you're getting a pretty bearish Hakinyashi candle here. Definitely a lower close. So that's not that we're not looking for a turnaround anytime soon on that. Looking at the 3 green arrow charts, we still have 3 red arrows. You're still well below the 30-day moving average, way below the 30-day moving average. In fact, when you look at it over here, the 30-day just barely crossed above the 50. Now, every time the 30, I think I brought this up too, every time the 30-day crosses below the 50, we do get a short-term rally. It happens all the time. You get the 30 crossing below the 50, you get a short-term rally up to moving averages. It happened here. It happened twice already this year on both of the other crosses. I fully expect that to happen again. I don't expect it will get up to the 30-day. I expect that we'll get up towards these lines right here, these Fibonacci lines, and get probably up towards the 17, maybe if not a little bit above it like it did here when we had this move. That's the kind of move I expect, but we definitely are due a short-term rally here considering how bearish we are. Obviously, looking at the Arun indicator or the hull, we are way below the 200-day hull. That's not turning green anytime soon. Everything is bearish here. We got a lower close again on today's candle. We're well below as I said, the 200-day hull there. When you look at the McClellan oscillator, I tweeted this out today as well. We are 24 days ago, the summation index was above 750. That's a high level. It's a really bullish level. 24 days ago, we were above 750. We are now almost below. We will most likely be below 750 by the end of the week. So more than likely, we will break that record. That 30 days was that was so abnormal. This was such an abnormal move to drop that far that fast. And of course, we know why. The economy literally shut down. And we dropped that far that fast. We went from positive 750. We were already below it by the time we got into the COVID. But then we went to minus 750. In 30 days is how long it took. 24 days right now. And I did have someone tweet out, and it was a very interesting thought, was, here, like, that was an act of God in COVID. The only thing that can beat an act of God is the Fed making a mistake. The Fed's mistake. But I don't believe necessarily the Fed's made a mistake. I believe the market made this mistake. I believe the market thought the Fed is going to pivot coming out of that July 27th meeting here. The market thought, hey, the Fed's going to have our back like they have always had our back. The reality is, what they didn't understand, what we talked about quite a bit, was they can't do that. Not with the real Fed funds rate as historically negative as it's ever been. They can't do that. And then Powell came out in Jackson Hole and said exactly that. And the market reacted. So I don't know if the Fed made the mistake. I think it was more the market here made the mistake and drove it way too bullish than it ever should have been. And it basically produced the mother of all fakeouts like we thought it would, right? Because remember, the unbalanced volume wasn't confirming it. It produced pretty much the mother. I mean, that was a pretty decent fake out there, and we got really bearish. This is even worse of a fake out because it suckered a lot of people into thinking, because it did produce a lot of really good bullish signals, but it was lacking some confirmations that we've pointed out, and it suckered in a lot of people into thinking that we were going to get the Tom Lee rally, the year-end rally back up to new highs, and of course, nowhere. That's not happening, right? When you look at the DMI, of course, we are, still very, very high on the negative indicator and below 15 now on the positive. So pretty low there. Still, the ADX is rising, is crossing above 25 now. So we're about to get dark pink shading again on that indicator. And you can see how long that can last if we end up getting up pretty far. When you look at the RSI and the CCI, again, the RSI is extremely low. That's very, very oversold in the short term. So expect a bounce there. We're coming up from being below minus 150 on that. When you look at, let's see here, the Ichimoku cloud, well below the green, very mature bearish trend. Again, one of the stronger bearish trends again that we've had, again, going back to these other two legs lower to the downside. Looking at the Bollinger Bands here, we are, below the band again, a second consecutive day below the band. We're easily below the Keltner channel, well below the Keltner channel. So, I mean, these are extreme bearish momentums and extreme moves. Again, you would expect, again, that, from an oversold condition that we're going to bounce up again towards these lines, but I do not think that we get significantly above this black and red line again. Not for a while, not for a long time. These are really important long-term levels. The red line's based off the 2009 low, the black line's based off the COVID low. They're both insanely significant support levels that we faked out with once. And usually when you get to it the second time, you don't fake out again the second time. So it doesn't mean it means low probability. It's not 0% chance. So there is a chance it could be a second fake out. And we could get, really good double bottom if that's the case. And then you would have your Tom Lee rally, just would be by the beginning of next year instead. But more than likely, the higher probability odds are we come back up towards the 17-day moving average, which will be in this area by then. Get a couple of pretty good bullish days that might get people thinking, oh, hey, we might be bullish again. But the reality is we won't be. And you'll have a good opportunity to unload any bullish trades you might not have already unloaded by then, and reduce your long-term positive delta exposure, which I'm sure every one of us has in our long-term portfolios, or in our passive trading portfolios. Let's take a look at today's intraday move. Of course, it was pretty much an inside day. I mean, it's almost exactly the same range as yesterday. Same move too, except we just didn't get as big of a late day rally. So equal high, equal low, pretty much staying in the range. We did get a new lower low, so again, from an Arun standpoint, that sets the clock again to a new 6 days. The green line popped back up again because now this has become the 4-week high point, but we're not going to touch that 4-week high point anytime soon. So that green line will just start to work its way back. It's over here now. It's going to start, I mean, now that this is gone, it's going to move over here. This is going to start to move towards the first day, and that green line is going to pop back below 0. Again, by the time that this would drop below 70, but you're nowhere near the upper half. Again, I think we get it towards the upper half, but then on any kind of short-term math, it's $20, so that's not going to be that small of a move. But then I think we kind of stall in that area again. I think sometime during this week we'll get that move. If not starting tomorrow, by the end of the week, we'll start to get that. When you look at the volatility today, it did ramp up. We did close above 100%. Woo, close above 100%. The bigger news is that the VVIX closed up well above 100%. So we got above 100 on Friday. It's well above 100 now. Remember, getting above 100 is bearish for this index. That's when you know that things are kind of hitting the fan. Again, that's where we got to in COVID. Then you've just been above 100 the whole time in COVID until earlier this year. Incidentally enough, during a bear market's when it dropped. But now it's back up. Now the VIX, things are going to be a lot more volatile because they're so highly correlated. The VIX is with this. It's so highly correlated that, you know, your VIX now is going to make moves. I mean, now we have closed above 100%. In fact, this is the higher close, the second highest close of the year on the VIX relative to the VIX 3M. The first highest was right there. We closed that day at 33.32. Today at 32.26. So that was the first highest day. So we're kind of getting an idea to see if we end up getting above 105% and then staying there, right, by the end of the day. I think we end up getting one of these days where we start up above 105 and then we close down below 105, if not below 100, which would be really bullish for the markets in the very short term and bearish for volatility. Again, when I say that I expect a short-term bullish move, I'm not expecting the markets to rally up to, you know, I don't even expect it to rally up very much, just enough over a short time frame to, you know, basically start, you know, to continue the leg lower that we're still on, the move to and through the 200-week moving average. See, we're still up above the 200-week moving average by simple moving average. We're still up above it by 1.7%. So, you know, I think we're still going to get through it. If we stop around 3,500, then this and bounce, this could very well just be a correction and we'll bounce up towards the 30, 50-week moving averages. I don't think that's the case because I think we've already had that move. I think the more likely scenario is we end up coming down to 3,200. Ups and downs in between, but we eventually get, this is the move to and through the 200-week moving average that starts bear markets. In that case, we'll probably get down to 3,200 before we do make a run back up towards 3,500. And then we start with the 7 months, right? Like in 2001, 2002, then we start that second period of, you know, a grouping of 3% declines, which is the actual bear market. That this one's not, because we started the whole phase: pullback, fail pullback bounce, correction, fail correction bounce, move to and through the 200-week moving average, return move, and then the bear market. That whole phase started up here in January. We were 45% above the 200-week moving average. That's the only reason why we've had 6 months so far of 3% or more declines and still haven't broken the 200-week. So it kind of gives you an idea. It looks like a bear market, but only because we were insanely bullish, way more insanely bullish than anyone wants to give the markets credit for. They kind of think that that was normal. That's not normal. That was insanely abnormal and not giving enough credit for being as abnormal as it was. This is actually a lot more normal. To be only this much above the 200-week moving average is actually a lot more normal. That was way, as you can see, way too abnormal. I mean, again, the highest in 20 years. And again, the only other time it was higher was 1987, right before the crash. And then the late 90s, those last few years in the late 90s. All right, now let's take a look at what's driving the price action here today. And you can see just today alone, again, it's the dollar story and yields again. So it's dollar and yields to the upside. Again, those are the three things that have been just killing everything all year long. Two of the three things. The third has been commodities, and commodities have been, instead of rising along with these, have been dropping. So you can see, look at bonds down 30% for the year. TLT is down 30% on the year. The dollar now is higher on the year than commodities are. Commodities up 12, only up 12%, and the dollar now up nearly 20%. Of course, famously, the pound U.S. dollars is the biggest currency that's made the biggest drop. It had a print below parity, but the reality is that was a bad print. If you look at the normal range today, it got down towards $1.03. It's on 1 minute chart, so it got down to about $1.03.5 and then rallied off of those lows by the end of the day. By the end of the day, it actually got up to $1.09 before pulling back to $1.06. So I mean, that's a pretty good move to the. In fact, that was higher than where we opened the day. So it made a pretty decent move, though still way down, still holding most of Friday's losses, which is the biggest deal. Of course, the euro is well below parity. It's going to hold below parity. I mean, it's significantly broken parity. It's going to hold this particular breakout. If I were to zoom out here, you can see we have broken the 78% retracement, which is a little bit above parity, and now we're working our way down. We've hit the 162% retracement of when we rallied off of that low point in 2020, off the COVID low. We rallied off of that. We've now dropped down and hit the 162% retracement. So there's going to be some support for the euro, some weakness for the dollar in this spot. Of course, the dollar against the yen, you can just see, is just gone parabolic. It's unbelievably parabolic. Needless to say, the dollar is extremely bullish against just about all of its peers. If I were to do a currency comparison chart here, and then again go year to date on this, you remember the dollar's up at 20%, the euro's down 15%, the pound's down now 21%, the yen is down here at 25%. So quickly, to give you an idea, the euro makes up 50% of that index. So how the euro does against the dollar makes up, the dollar index itself the euro itself makes up 57%. You saw the yen makes up 13% of the dollar. So the combined, they make up 70%. And then you got a 12% from the pound. Those are the only three that are in the double digits. The Canadian dollar makes up the biggest component of the trade-weighted index because they're our biggest trading partner. But they only make up 9% of the actual dollar index. And then you have the franc and the krona, half of that. So those two combined don't even make up what the Canadian dollar does. But those, so the pound's the third biggest. So between the three of these, you're looking at 70, 82, nearly about 83, a little bit more than 83% combined, those three currencies. So you look at, again, the pound 21, the yen 25, the euro 15. So, I mean, the dollar is strongly bullish. You notice it's not as strongly bullish against the Canadian dollar. It has here lately fallen against the loonie, but it's not down nearly as much. Remember, that makes up 9% of the dollar index. And there's the franc as well. The Mexican peso, which is another large trading partner of ours, is actually up against the dollar. So it's not so much the dollar that's necessarily strong, because you can see even the Aussie's only 10% down. It's more the fact that the pound and the yen, especially those two, are just extremely bearish. Those two come because you can see the yen's down against everybody. The pound is down against everybody except the Scandinavian currencies. The pound's down against everybody. The euro is down also against everybody except for the pound and the yen, and the Scandinavian currencies, and then the Kiwi, a little bit of the Kiwi. So, I mean, those are all. I mean, these currencies are down against everybody. That's how bearish. I mean, the yen's down against the pound. That's how bearish the yen is. The pound and the yen are down against the euro. That's how bad the pound and the yen are. And again, all three of them are down against most of the major currencies that are out there. So they're very bearish, and that's lifting the dollar up. And the dollar just continues. It's really going parabolic here. So when you look at the DMI for UUP, I mean, it's above 50. We were above 50 over here when we had a streak right there. But again, you look at just how bullish we've been in the last 1, 2, 3, 4, 5 days. So if I do a rate of change for UUP for 5 days, I already showed you 4 days, right? Going into today. But now add on this 5th day and take a look at UUP. I mean, again, COVID, but you remember how just anomalous the COVID move is. So outside of that anomaly of a move, no other move in 5 years that's been bigger than this. If I were to, let's draw this, and let's go 4.35%, 4.357% essentially. So that's where we are. So again, only COVID had a 5-day move that's bigger to the upside. Nothing else in 20 years except for the great financial crisis, the worst part of it, like early October, when when it was hitting the fan and hitting it hard in 2008, that had a bigger gain in 5 days on the dollar as a safe haven currency, right? And again, you can see there at the end of October, kind of the second wave of really strong dollar bullishness. And they got up to almost 6%. So, and not very much bigger. So this, needless to say, this is a very out of the ordinary move. Like even, I mean, that it's like 2% would be a very strong move. So this is more than double what is already a very strong move. That's how out of the ordinary this move is on the dollar in the last 5 days. It's really, really gone parabolic. Again, it's not common for the blue line to get above 50. You know, obviously it did earlier this year, but if I were to go back out again 20 years and then draw this line over here to 50, so let's do 50 here. And again, we're looking at the blue line, right? You can see in 2020 in COVID, we had a couple instances. There in 2018, we had an instance there early in 2016 or late in 2016, right after the election. We had an instance of it getting up above. You can see the negatives not below 10. It's hard for the negative to get to below 10. It did it over here during that 2018 period. And that didn't necessarily make the dollar stop going up, right? The dollar actually kept going up even after that. Of course, you can see 2014 in September, the dollar, that was during the big dollar rally that we currently, you know, that the other big dollar rally we had to the upside. So in fact, the ADX there at the beginning of 2014 got well above 50. And right now your ADX, and the ADX has never gotten that high again. It got over here during 2018, got about to 45. Didn't get that high in 2020, and it's currently only at 25 right now. It got above 40 earlier this year for one of, you know, again, not a very common time, and we had all those clusters. We're not even getting a cluster right now on the dollar, excuse me, on the dollar as bullish as it is. So it's an extreme move. It's an unbelievably, it's an extreme move to the upside. Interesting, the momentum, because of the gaps, the momentum and is not, that's why your momentum line is not higher. But that's really, I mean, TLT is down, extremely down. When you look at it below, like say the 200-day moving average, you know, again, we were well below that in June. That's when we had the big washout, right? We were, if I were to go over here and look at how far below the 200-day moving average we were way below that in June, 20% below, biggest ever for TLT, for this ETF. In fact, I can go max available. And again, that was the biggest ever for this ETF to be below 20%. I mean, getting 10% was previously the low point. So we were 20% below. We're 17 now. Now we're forming, you know, what may be, you know, one of the most ultimate divergence plays, like lower lows with higher, because I don't think we're going to get below 20% again. So we're forming a really significant divergence. So as we get closer to 100, again, getting to 100, you know, last time we were at 100 was going into 2011, going into the credit crisis. We had traded below 100 for most of that period. After the stock market bottom, we only got to 120 during the great financial crisis. We came easily back down below 100 and stayed there for most of that time until the financial crisis. Then we haven't been below 100 cents, right, since the financial crisis. Well, remember, we got to 120 at the worst of the financial crisis. We got to 170 coming out of COVID. So that's how bullish bonds have been for pretty much this entire bull market in equities. Well, now it's back down to 103. So, you know, that's a pretty significant move. It's well below the 200-day moving average. And as you can see, if I were to go all the way back, max available, it's the lowest below the 200-week moving average it's ever been. So all these other times, you know, we got just barely below the 200-week, including the bear market for bonds that precipitated what we're seeing now, or this bear market over here. Well, now this is a much more significant bear market. And again, to kind of give you an idea, like, you know, the bull market that we had in bonds here, that started in 2018. So that was, you know, when we kind of had some weakness. And I'm not even going to include the highest point. I'm just going to go up to where we kind of maintain a position there at the highest point. we're below that low and further below. Like, you know, we've well gone below that, and you can see the 162% retracement level would be right about at 75, and it's very, very low likelihood that we would get, you know, again, all the way down to that point. But can we get all the way down to 102? Again, the low point there in 2013 at the height of QE3 before we started tapering QE3. You know, very, very decent probability that we ultimately at least find some support in that area. Let's take one more look at the sector moves here before we look at our trade idea for the day. So as always, I told you before, when we're in a bear market, everything's bearish. So when you look at the 12 grid, we have dark pink shading the red line across the board. So that's a pretty good sign that we are in bear market mode. We're not rotating. Everything's selling off. That's what happens in a bear market. And if I were to look at just today alone, September 26th, and then come into this, you can see the biggest losers, interestingly enough, were utilities and real estate. Interest rate sensitive areas, right? So the interest rates were higher. It pushed those two areas down. They're also considered safety trade. So, you know, on a down day, they were the biggest losers. Staples held ground pretty okay. Energy was a big loser. That's been a safe haven for most of this year with commodities doing well. But the rest of your cyclical areas, industrials, financials, materials, all lagging the market. XLC lagged a little bit. It's been a big decliner for most of the year too. XLK and XLY actually beat the markets. So pretty good sign that on a down day, you actually had pretty decent outperformance as most of those mega cap names still holding up, especially Apple, which is the biggest component, holding up relatively well versus the rest of the market. All right, now let's take a look at our trade idea of the day. I want to take a look at Lockheed Martin. You can see it's not been as bearish as the rest of the market. The intermediate line has just barely gotten to bearish territory. You're only 4% below the moving average. You just started kind of dark pink shading and red line, but we're not anywhere close to those mid-June. Well, I guess we're close to mid-June lows, but this had its own even further lower low in July. In fact, when you look at the rally we had here for most of the early part of this year going into and through the Ukraine invasion that really kind of helped these defense stocks, we pulled back and we're just barely below the 38% retracement. And we're kind of in the retracement zone, but really not breaking out. In fact, when you look at the Bollinger Bands, the bandwidth is really low, very, very low bandwidth. Yes, we are below the lower band, but you notice we have a volume node here at the 23% retracement level, the biggest one, so the point of control. We also have the volume node here at the bottom of the Fibonacci retracement area at the 62% retracement. So we have, you know, an area of no volume in between. So we're kind of like stuck here in the middle between two significant volume nodes acting as resistance and support on either side with not very much of a trend. When you look at the trend strength, yes, we are below the cloud, barely, but just barely. And you have a weak bearish trend going. That's it. Remember that the S&P's trend is strongly, very mature in the bearishness. This is just barely weak. So it's not very strong of a move. If you look at the DMI, both the positive and the negative are below 25. So neither one of them are really not really trending in either direction. So what I decided to do here was say, okay, well, let's take a look at selling an iron condor spread. So I'll sell the call spread at the low 20 deltas, sell the put spread also at the low 20 deltas. You can see what that looks like here, the full position size for what we typically do in our class portfolio. Pretty decent reward for that, so I'm willing to give up $480. And then you can see those break evens that I have there where they fit. So those break evens fit here on where those two volume nodes are, the upper one at the top and the lower one at the bottom. So as long as we stay in between the two volume nodes, which you expect we will until you break out. If you break out, you're going to be trending one way or the other. And so that would be okay. Well, I'm willing to get out of this trade if we start to trend one way or the other. But if we don't, then that's how we make money on this relatively higher probability setup for a pretty decent reward. I mean, that's well more than what we normally get for $1,000 of risk on a short premium trade like this. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us at marketscholars.com for free. Like us on Twitter and Facebook. Have a great rest of your Monday night, everybody, and we'll see you all next time.